If you had to pick one fund for the next 12 months, would you pick last year's number one performer? Most people would. And most of the time, that's exactly the wrong instinct. It feels obvious, right? The fund that just delivered the best return clearly has the best fund manager, the best stock picks, the best everything. So logically, it should keep winning. This is why so much investing behavior, not just retail investors, plenty of experienced people too, is driven by looking at last year's top-ranked fund and moving money into it. It seems like following the evidence. But what won last year and what wins next year are answering to very different questions. And treating them as the same question is one of the most common and expensive mistakes in investing. Let's break down why this happens, step by step. First, why a fund tops the charts in the first place. A fund doesn't outperform in a vacuum. It outperforms because it was positioned in the right place at the right time, heavier in the sectors or market cap segments that happened to do well, holding the specific stocks that happened to run up. That positioning is a bet. Sometimes it's a well-researched bet, sometimes it's a lucky one, and from the outside, just looking at a return number, you genuinely cannot tell the difference between the two. Second, the idea of mean reversion itself. Mean reversion is simply the tendency for something that has performed unusually well or unusually badly to drift back toward its long-term average over time. It shows up everywhere in investing because most drivers of extreme performance, a stock that ran up 60% in a year, a sector that suddenly came into favor, don't repeat the same magnitude of move indefinitely. Growth rates, valuations, and market enthusiasm all tend to normalize. So a fund manager who was sitting in exactly the right stocks last year has already captured most of that upside. Those same stocks now need to run up again by a similar amount for the fund to repeat the feat. That's a much harder ask than it sounds. Third, what's actually happening under the hood of a hot fund? Here's the more useful question to ask about a top performer. Has the manager changed the underlying portfolio, or are they holding the same winners? If a fund delivered a strong return and the manager has largely kept the same stocks that drove it, the fund is now leaning on those same names to keep running up from an already elevated level, which is a lower probability outcome. But if the manager has meaningfully reshuffled the portfolio, taken profits, moved into names that haven't run up yet, the fund isn't relying on the same trick twice. This single distinction, more than the headline return number, tells you whether a fund's good year is likely to be a starting point or an ending point. Fourth, it cuts both ways. Mean reversion isn't only a warning about chasing winners. It's also a reason not to panic sell a fund purely because it had a rough year. A fund sitting in unloved stocks or an out-of-favor category can be closer to a turnaround than its recent return suggests, especially if the manager hasn't changed strategy and is still waiting for the stocks they hold to be recognized by the market. Judging a fund only on its last 12 months in either direction misses this. Fifth, this is exactly why disciplined fund selection processes deliberately look forward, not backward. Purely historical return chasing is, structurally, a mean reversion trap. A more robust approach weighs a broader set of signals: forward earnings potential, how differentiated the portfolio is from its benchmark, and yes, whether the manager has meaningfully changed the portfolio after a strong or weak run. Precisely because relying on trailing returns alone tends to reward funds right before their luck or their sector turns. Here's a simplified, illustrative example. Treat this as a hypothetical, not an actual fund. Say Fund X delivered a standout 50% return last year, built almost entirely on a concentrated set of 30 stocks that each rallied hard. If the manager still holds those same 30 stocks going into this year, the fund needs those already expensive winners to keep running, a tougher bet. If instead the manager has rotated out of half those names into stocks that haven't yet had their run, the fund's fate this year depends less on repeating last year's exact story. On the data side, some backtested historical analysis, illustrative, past performance only, not indicative of future results, has found that a fund which was in the top performance quartile over the last year has only roughly a 1 in 4 chance of remaining in the top quartile the following year, while a fund in the bottom quartile has historically had a notably higher chance of moving up into the better quartiles. That asymmetry is mean reversion showing up in the numbers. Next time you're tempted by a fund's chart-topping recent return, ask one question first. Is this manager still riding the same wave that already happened, or have they moved on to the next one? The answer matters more than the number. That's the mean reversion trap, why we should look at process and positioning, not just last year's scoreboard. Thanks for watching. Check out the video description. We've packed it with resources just for you. If you found this video helpful, please give it a thumbs up and share it with someone who needs it.